Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HIMS and HERS Health.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, if you've been looking at the healthcare sector lately, you know that finding a genuinely compelling setup right now can feel a bit like navigating a minefield.
Oh, absolutely. It's incredibly volatile out there.
Right. But today, we are examining a stock chart that tells just this incredibly dramatic story. I mean, picture this in your portfolio.
Yeah.
You're looking at a company that experienced a catastrophic, a severe 70% crash from its all-time high of $70.
Yeah, that's brutal.
The stock plummeted down below $21 a share, looked like a total wipeout, and then, seemingly out of nowhere, it spikes 40% in a single week.
Which is wild. And, the volatility we are seeing here completely shakes out retail investors, but it makes institutional players pay very close attention.
For sure.
Because the mechanics behind that massive swing really warrant a closer look. It wasn't just random market noise. It was a fundamental shift in the company's entire narrative.
So what does this all mean for your portfolio?
Yeah.
That is our mission today. We are going to analyze the great pivot of HIMS and HERS Health. We'll break down the underlying fundamentals, the technical momentum driving that price action, the immediate catalysts on the horizon, and we will aggressively stress test the bear case.
Right. We have to.
Exactly. We need to figure out if this setup, which is currently grading out as an 8 out of 10, highly bullish long-term investment thesis, actually holds up to scrutiny.
And to appreciate why this stock is suddenly surging with such aggression, we have to rewind. We need to understand the existential crisis that preceded it, because the recovery just doesn't make sense without the context of the crash.
So what actually caused that 70% drop in the first place? I mean, they were making money, right?
They were. Historically, they built this massive revenue engine by relying heavily on compounded GLP-1 weight loss drugs. And GLP-1s are, the active compounds in those blockbuster weight loss medications you hear about constantly in the news.
Right, the ones everyone's trying to get their hands on.
Exactly. Now, during the massive global shortage of the branded versions of these drugs, compounding pharmacies were legally allowed to step in. They produced copycat versions to meet patient demand. And the company capitalized on this beautifully, selling these highly profitable in-house versions.
Hold on, let me stop you there because the legality of that is confusing to a lot of people.
Yeah, it's a bit of a gray area for most.
Right. What does compounded actually mean, both medically and legally? Because it sounds like they were just bootlegging drugs.
It kind of does, yeah. But it's a crucial distinction. Normally, a pharmaceutical company holds an ironclad patent on a drug, right? And nobody else can manufacture it.
Obviously.
However, the FDA has this specific regulatory carve-out. When a vital medication goes on the FDA's official drug shortage list, those patent protections are temporarily suspended.
Wow, okay. I didn't realize they were fully suspended.
Yeah, for the duration of the shortage. So state-licensed compounding pharmacies are then permitted to take the raw, active pharmaceutical ingredients, mix them, and distribute them to patients who just can't get the branded drug.
Because the supply chain is so backed up.
Exactly. And because the company was overseeing the production of these compounded versions, they didn't have to share the profits with a giant pharmaceutical company. The profit margins were enormous.
But the catch is that the FDA only allows that during an official drug shortage.
Right.
So the moment the FDA declares the supply chain is fixed, that entire business model becomes illegal overnight.
Which is the exact mechanism that triggered the crash. In early 2025, the FDA announced the resolution of the drug shortage.
Oh, man.
Yeah. That single regulatory shift signaled the absolute end of the high-margin, compounded GLP-1 era. Almost instantaneously, this incredibly lucrative revenue stream transformed into a massive legal liability.
Because if they keep selling it, they get sued into oblivion.
Exactly. Wall Street looked at this and completely panicked. They sold off the stock, driving that brutal 70% drawdown we talked about.
They were essentially operating on borrowed time.
Completely.
But here's where the timeline gets fascinating. Just when the market thought the company was going to be destroyed by lawsuits, we hit March 9th, 2026. They announced a landmark partnership with Novo Nordisk, the pharmaceutical giant behind these exact blockbuster weight loss drugs.
And that announcement completely altered the investment thesis. As part of this settlement, a looming patent infringement lawsuit was totally dismissed.
It's wiped away.
Gone. The massive legal overhang that was suffocating the stock's valuation was eliminated.
Thinking about the mechanics of this, it feels like a rogue pirate deciding to go completely legitimate.
I love that analogy.
Right. Because for years, they're out there operating in the compounding waters. It's highly profitable, but super dangerous. Wall Street views them as this pirate ship that could be sunk by the FDA at literally any moment.
Yeah, one regulatory update and they're done.
But they don't get sunk. Instead, they sign a treaty with the biggest empire on the ocean. They transition from a regulatory liability to becoming the official, legitimate digital distribution arm for Big Pharma.
And the market psychology reflects that transition perfectly. When a heavily shorted stock suddenly removes its primary existential risk, the market mechanics force a massive correction.
We are talking about a short squeeze here.
Yes, a violent one.
For anyone listening who maybe doesn't trade options or short stocks, can you break down the actual plumbing of how a short squeeze creates a 40% spike in a single week? Because that is not normal buying pressure.
No, it's forced buying pressure. Let's look at the plumbing. When an investor shorts a stock, they are borrowing shares from a broker, selling them at the current price, and hoping the price goes down.
Right, betting against the company.
Exactly. Their goal is to buy those shares back later at a cheaper price, return them to the broker, and pocket the difference. But if the company suddenly releases incredible news like dismissing a massive lawsuit and partnering with Novo Nordisk, the stock price starts rocketing upward.
And those short sellers start losing money fast.
They start bleeding capital. Every dollar it goes up is a dollar they lose. At a certain point, the broker steps in and issues a margin call.
Which is the terrifying phone call nobody wants.
The worst. It forces those short sellers to buy back the stock immediately at whatever the current market price is, just to close their positions and stop the bleeding.
Wow.
So you have a flood of regular investors buying the good news, plus a flood of panicked short sellers who are mathematically forced to buy. That double wave of aggressive buying volume is the direct causal mechanism behind that 40% single-week price surge.
It's just a powder keg. But, a short squeeze is just a temporary market anomaly. A stock only sustains that kind of momentum over a 12 to 18-month horizon if the underlying business is actually generating cash.
You cannot build a long-term portfolio on short squeezes.
Exactly. So let's look at the actual numbers driving this digital storefront. Are they actually making money?
Well, the scale of their operation is undeniably massive. If we look back at 2020, they had roughly 290,000 subscribers on the platform.
Okay.
Fast forward to 2025, they zoomed past 2.5 million subscribers.
That's insane.
It's explosive growth, and that subscriber base is now generating annual revenue that has reached $1.5 billion.
Wait, jumping from 290,000 to 2.5 million in that time frame requires an incredible customer acquisition strategy. What is the actual hook getting those millions of people in the door?
They have built a competitive moat using what we call a network effect. They act as a virtual front door to the healthcare system.
Because the traditional system is a nightmare.
It's full of friction. You have to book an appointment, sit in a waiting room, read a magazine from 5 years ago, and then talk face-to-face with a doctor about something that might be deeply embarrassing.
Yeah.
Nobody wants to do that.
Right. The company realized that if you can entirely digitize and destigmatize low acuity, highly sensitive needs, things like hair loss or erectile dysfunction, you can capture the customer at a very low acquisition cost.
They just do a quick online consultation and they're in.
Exactly. It's seamless.
And then the economics shift once the customer is inside the ecosystem, right?
The lifetime value of that customer changes dramatically. Once they have built that trust and normalized the telemedicine experience for you, they successfully upsell you into higher acuity, long-term care verticals.
Ah, I see.
So the platform you initially used for hair loss is now managing your mental health treatments or your weight loss journey.
It's brilliant. But I have to play the skeptic here because pivoting a massive digital platform is incredibly expensive.
Oh, without a doubt.
Going from selling high-margin, in-house compounded drugs to acting as a distributor for branded, FDA-approved big pharma drugs requires an entirely different operational infrastructure.
Totally different supply chain. Right. How do they actually pay for this transition without burning through all their cash and going bankrupt?
Institutional investors were scrutinizing that exact risk, actually. But the balance sheet is surprisingly robust. They have secured $1.2 billion in total funding, which includes a major post-IPO debt facility they locked in back in June of 2025.
So they essentially saw the regulatory hammer coming
Right.
and built a massive war chest beforehand.
They were ready for it. The liquidity gives them a massive runway. It allows them to execute their pivot, building out the infrastructure for branded distribution and investing in new product lines without facing any immediate solvency concerns.
That's a huge relief for investors.
It is. And furthermore, we need to look at their 2026 EBITDA guidance.
Let's pause on EBITDA, because that's a metric Wall Street throws around constantly. But for a retail investor trying to understand the health of this company, what does their EBITDA actually signal here?
Good question. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is essentially a raw measure of a company's core operational cash flow. In the early stages of a tech or digital health company, EBITDA is usually heavily negative because they are burning venture capital to acquire customers.
They're just spending on ads and marketing.
Exactly. The fact that they are projecting strong, positive EBITDA guidance for 2026 signals a deliberate shift away from high capital burn. They are proving to Wall Street that their core operations can actually generate cash, moving towards sustainable operational efficiency.
So the platform is growing, they have a massive war chest, and the cash flow is moving in the right direction.
Yes.
But Wall Street is still heavily divided on how to value this new, fully legitimate version of the company. We need to unpack the risks because the market is definitely pricing in some fear right now.
Let's analyze the recent price action to understand that fear. Because after the explosive 57% run-up from the bottom, the stock dropped roughly 11.5%. It settled around the $22.02 mark.
So it dropped 11% recently. Is that a sign the rally is already dying out?
Actually, no. A pullback of that size after a massive run is an indicator of a healthy market structure.
Really?
Yeah. Think about it. If a stock shoots straight up in a vertical line, it's usually driven by wild retail speculation and is prone to a devastating crash. An 11% pullback allows the stock to digest those gains.
It cools off a bit.
Exactly. It typically suggests active institutional accumulation at those levels. Smart money scales into their positions on red days, building a foundation of support.
So the technicals look like healthy consolidation. But what about the fundamentals? Because if I'm listening to this right now, I'm probably thinking, great, they partnered with Novo Nordisk. But if Novo is the only one making the branded drug, aren't they just going to squeeze the platform out of all their profits?
You just articulated the primary bear case perfectly. Margin compression.
It's a real fear.
It is. Yes, the partnership removes the legal risk, but branded FDA-approved drugs carry significantly lower profit margins than the old in-house compounded versions.
Right, because when you manufacture it yourself, you keep the entire margin.
Exactly. When you distribute for Novo Nordisk, they take a massive cut.
And Novo holds all the leverage.
Novo Nordisk has a total monopoly on the branded supply. Analysts are calling this a severe Novo dependency.
Ouch.
Yeah, if Novo changes the distribution terms, raises wholesale prices, or faces a manufacturing supply chain issue, the margins get squeezed even further. Because of this dynamic, some major analysts have heavily slashed their fair value estimates by 47%.
Wow, 47%.
Yeah, bringing their target down to $23.69.
Okay, I understand the fear of margin compression, but from a valuation standpoint, I have to challenge that bearish outlook.
Let's hear it.
The stock is still down roughly 70% from its all-time highs. It is currently trading at roughly 2.4 times sales.
Let's break down that multiple.
Please do, because for anyone who doesn't look at price-to-sales ratios all day, why is a multiple of 2.4 considered a distressed valuation in the software or digital platform space?
Well, the price-to-sales ratio simply compares a company's total market capitalization to its annual revenue. High-growth software and digital platform companies often trade at 8, 10, or even 15 times their sales.
Right, because their margins are usually amazing.
Exactly. The market assumes their digital infrastructure will eventually yield massive profit margins. So when a digital platform is trading at only 2.4 times sales, the market is severely discounting its future.
They're pricing it like it's dying.
It means investors are terrified that the company will struggle to turn that revenue into actual profit.
It is priced for an absolute worst-case margin environment. I mean, the market has already punished them for the Novo dependency. What the bears seem to be missing is the qualitative shift in the narrative.
The sentiment change.
Right. The sentiment has transitioned from an uninvestable existential risk, where the FDA might literally shut the business down, to a much more manageable execution risk.
Which is a huge difference.
Exactly. Can they execute a lower margin, high volume strategy? That is a standard business challenge, not a legal death sentence. Even Citi analysts recently put out a note explicitly stating that the Novo Pact significantly reduces risks.
And that transition from existential risk to execution risk is really the foundation of the bullish thesis.
Right.
If we operate on the premise that the bearish margin compression is already mostly priced in at these distressed $22 levels, the natural next step for an investor is to look at the horizon.
What's coming next?
Exactly. What are the actual events, the catalysts in the next 3 to 12 months that will force Wall Street to re-rate the stock higher?
Yes, what actually drives the stock back up from $22? Let's look at the catalyst calendar.
So the most immediate, tangible catalyst is the active, ongoing rollout of Novo Nordisk's FDA-approved GLP-1s directly on the platform. And the focal point of this rollout is the highly anticipated launch of the oral Wegovy pill.
The oral pill changes the entire landscape.
It really does.
Because right now, the biggest barrier to entry for these weight loss drugs, aside from the high cost of the supply shortages, is the needle. People have a visceral psychological aversion to injecting themselves every week.
Oh, needle phobia is not just a slight preference. It is a profound medical friction point that keeps millions of potential patients out of the market entirely.
People just will not do it.
They won't. By offering an FDA-approved, highly effective oral alternative on a seamless digital platform, they are positioned to capture massive market share from that vast demographic. The rollout of a pill expands their total addressable market almost overnight.
It unlocks a massive tier of customers who have literally been sitting on the sidelines waiting for an easier option.
Exactly.
And as that rollout executes and the revenue from the branded pills starts showing up in the quarterly earnings reports, we should expect near-term positive analyst revisions, right?
Right, absolutely. Wall Street analysts are notoriously slow to update their financial models. They're currently digesting the pivot and waiting for proof.
They want to see the numbers.
Right. As the execution gets proven out in the data, those price targets are going to start creeping up. Furthermore, we must frame these company-specific catalysts within the broader macro trend.
The gold rush.
We are currently living through a weight loss gold rush. It remains arguably the single strongest secular trend in the entire healthcare sector right now.
It's everywhere.
For the past 2 years, global supply constraints for these GLP-1 medications have throttled growth. But those supply chains are finally starting to ease. As the medication becomes more widely available, the company has positioned itself perfectly as a primary, trusted digital distributor at exactly the right moment.
They basically finish building the digital toll road just as the manufacturing traffic jam is clearing up.
That's a great way to look at it.
And on top of all that, let's look at some speculative expansion that could act as a massive sleeper catalyst. The international push.
Oh, this is huge.
Because they are no longer just a domestic play. They are actively operating in 23 different countries.
And that international footprint provides 2 massive advantages. First, operating in 23 countries opens the door for enormous international subscriber growth.
Right.
They are tapping into global markets that are just beginning to experience the cultural phenomena of these weight loss drugs. Second, from an institutional perspective, that established global scale makes them incredibly attractive for potential mergers and acquisitions down the road.
So let's bring all these threads together and summarize the final investment thesis. What is the core takeaway for you as an investor deciding what to do with this stock?
We are looking at a setup that grades out as an 8 out of 10 on the bullish scale. They have taken what was essentially a company-ending legal liability and masterfully transformed it into a highly lucrative, entirely legitimate distribution partnership with Big Pharma. They survived the regulatory storm and secured the strongest possible partner in the space. At the current distressed valuation levels around $22, where the market is heavily obsessing over margin compression that is likely already priced into the stock, the risk-to-reward profile appears heavily skewed to the upside.
For sure.
For investors with a 12 to 18-month horizon, this represents a strong long-term buy. It simply takes time for the market to fully verify that the new branded drug revenue can sustainably and profitably replace the old compounded revenue.
You just have to give the execution time to play out in the earnings reports. But before we wrap up, I want to leave you with a final, slightly provocative thought to chew on regarding that M&A potential we just touched on.
Let's hear the theory.
Think about the broader pharmaceutical landscape. If they successfully prove over the next 12 to 18 months that they are undeniably the ultimate digital storefront for Novo Nordisk's massive weight loss empire, how long will it take before other massive pharmaceutical giants realize they are falling behind? Companies that are currently struggling with direct-to-consumer digital distribution will eventually realize they must partner with platforms exactly like this just to survive the transition to digital healthcare.
Owning the customer relationship is the ultimate endgame of the virtual front door strategy.
Exactly. Could this brilliant pivot from a gray market compounding pharmacy to a legitimate global distributor actually make them the ultimate indispensable acquisition target for Big Pharma? It is absolutely something to consider as you watch this stock over the next year. Until next time, keep doing your own research, and thanks for tuning in.